What is a vertical debit spread? A spread is any trade that uses two options, one bought and one sold, to balance risk and reward. Debit means we pay to open this position with the goal of closing it at a higher price. Vertical means the options have different strike prices but expire at the same time. InvestorsObserver uses two kinds of vertical debit spreads. The bull call debit spread. These are bullish positions where we buy a call and then sell another call with a higher strike price against the first one. We also use bear put debit spreads. This is essentially a bull call spread turned upside down. We buy one put and then sell a put with a lower strike price for a net debit. How does it work? First step, buy a call. This gives us the right to buy the stock at the strike price. Step 2, sell another call. This offsets a portion of the price of the first call. Also potentially obligates us to sell the stock at that strike price. Our net cost to enter should be less than the difference in strike prices. Step 3, close the trade. We should be able to close the trade for the difference in strike prices, or very close to it. How does it work? The bought call lets us buy the stock at that strike price. The sold call potentially obligates us to sell at that strike price. Between the two strike prices, our outcome varies between a loss and a smaller than expected profit. Here's an example. The August 56 58.50 bull call spread on Nike for $1.80 debit. We bought the August $56 call for $3.30 and then sold the August 58.50 call for $1.50. That means we paid $1.80 to get into this trade. Our target profit is the difference in strike prices, or $2.50, minus our net debit, or the cost you paid to enter, or 70 cents. That gives us a target return of 39%. Let's put it all together. As long as the stock is above the strike price of our sold call at expiration, the options will be worth the difference in strike prices. We'll be allowed to buy the stock for $56 and then sell it for $58.50. We get $2.50 on the exit after we paid $1.80 to get in. What can go wrong? If the stock is below the sold call and above the bought call at expiration, the trade's results will vary between a smaller than expected profit and a loss. Below 58.50, we can still buy the stock for 56 and then sell it for whatever we can get for it. So we have a variable outcome between the two strike prices. Well, below 56, both options will expire worthless, and the most we can lose in this case is our initial $1.80 per share investment. Let's wrap it up. Vertical debit spreads can be a low-cost way to bet that a stock will rise or fall. The risk is limited to our initial debit. The strategy allows for relatively high returns while also potentially providing some downside protection.